Section 3.1 to 3.3 Understanding Dividend Yield, Factors Affecting Dividend Yield. 3.1 Company Financial Performance. The relationship between a company's profitability, cash flow, and dividend yield is interconnected and plays a significant role in determining the dividend yield. Here's how these factors are related. Profitability. Profitability refers to a company's ability to generate earnings from its operations. Companies with higher profitability generally have more resources available to distribute as dividends. Higher profitability indicates that the company is generating sufficient earnings to cover its operating expenses, debt obligations, and potential dividend payments. When a company is highly profitable, it has the potential to allocate a larger portion of its earnings towards dividend payments, leading to a higher dividend yield. Profitability is a fundamental driver of dividend yield, as a higher level of profitability increases the likelihood of a company paying dividends and potentially increasing them over time. Cash flow. Cash flow is the movement of money into and out of a company, reflecting its ability to generate and manage cash. Positive cash flow is vital for sustaining dividend payments. It represents the actual cash available to the company to meet its financial obligations, including dividends. Strong cash flow is important for maintaining a stable and sustainable dividend policy. Companies with consistent and growing cash flows are better positioned to support dividend payments, even during periods of economic downturn or business challenges. Adequate cash flow helps ensure that a company can meet its dividend commitments without jeopardizing its financial health. Dividend yield. Dividend yield is the ratio of the annual dividend per share to the stock's market price per share, expressed as a percentage. It represents the income generated by an investment relative to its price. A higher dividend yield indicates a higher income potential for investors. Profitability and cash flow directly influence the dividend yield. When a company is highly profitable and generates strong cash flows, it has the financial means to pay dividends. This can result in a higher dividend yield, as the company can distribute a larger portion of its earnings to shareholders. However, it's important to note that a company's profitability and cash flow alone do not determine the dividend yield. Other factors, such as the company's dividend policy, debt levels, reinvestment requirements, and industry dynamics, also play a role. Nevertheless, profitability and cash flow are key indicators of a company's ability to sustain dividend payments and can have a direct impact on the dividend yield. Investors often seek companies with a track record of consistent profitability and healthy cash flows, as they provide a higher level of confidence in the sustainability of dividends and potentially lead to a higher dividend yield. However, it's important to consider the specific circumstances of each company and conduct a comprehensive analysis that incorporates other relevant factors before making investment decisions. Financial health and stability have a significant impact on a company's ability to pay dividends. Here's a closer look at how financial health influences dividend payments. Cash availability. Dividend payments require cash, and a financially healthy company is more likely to have sufficient cash reserves to meet its dividend obligations. A company with strong financial health maintains a balance between its cash inflows and outflows, ensuring it has the necessary liquidity to pay dividends consistently. Adequate cash availability is crucial for sustaining dividend payments, especially during challenging economic conditions. Profitability and earnings. A financially healthy company typically exhibits consistent profitability and earnings growth. Higher profits provide the foundation for dividend payments. A company with stable or increasing earnings is more likely to have the financial capacity to allocate a portion of its profits as dividends. Sustainable profitability is a key indicator of a company's ability to generate the necessary cash flows to support dividend payments. Debt levels and financial obligations. Excessive debt can put strain on a company's financial health and impact its ability to pay dividends. High levels of debt may require the company to allocate a significant portion of its cash flow towards interest payments and debt servicing, limiting the funds available for dividend distributions. Companies with lower debt levels and manageable financial obligations are generally better positioned to prioritize dividend payments. Retained earnings. Retained earnings represent the portion of a company's profits that are reinvested back into the business rather than paid out as dividends. Financially healthy companies often strike a balance between distributing dividends and retaining earnings for reinvestment. Adequate retained earnings can support future dividend growth and enhance the stability of dividend payments. Industry and market dynamics. Financial health is also influenced by industry dynamics and market conditions. Companies operating in stable industries or those with strong market positions may exhibit greater financial stability, making it more likely for them to maintain consistent dividend payments. Conversely, companies in cyclical or highly competitive industries may experience more variability in their financial health, impacting their ability to sustain dividends. It's important to note that financial health is a dynamic concept and can change over time. External factors such as economic recessions, industry disruptions, or shifts in market conditions can impact a company's financial health and, consequently, its ability to pay dividends. Investors should carefully assess a company's financial statements, including metrics like profitability, cash flow, debt levels, and retained earnings, to evaluate its financial health and stability. A financially healthy company with a strong balance sheet and sustainable cash flow generation is more likely to maintain stable dividend payments, providing investors with a reliable income stream and potential dividend yield. 3.2 Industry and sector considerations. Dividend policies and yield can vary significantly across different industries and sectors. Here's a look at some factors that contribute to these variations. Industry characteristics. Industries differ in their capital requirements, growth prospects, and cash flow patterns, which influence their dividend policies. Mature and stable industries such as utilities, consumer staples, and telecommunications tend to have a higher propensity for paying dividends. These industries typically generate steady cash flows and have less need for reinvestment. In contrast, industries like technology or biotechnology may prioritize reinvesting earnings for research and development or acquisitions, resulting in lower dividend payouts. Regulatory environment. Certain industries, such as utilities or real estate investment trusts, REITs, are subject to regulatory frameworks that influence their dividend policies. Regulated industries often have stable cash flows and are required to distribute a significant portion of their earnings as dividends. The regulatory environment can contribute to higher dividend yields in these sectors. Growth opportunities. Companies in industries with significant growth opportunities may choose to reinvest earnings into expanding their operations, research and development, or acquiring new assets. These companies may have lower dividend payouts and, consequently, lower dividend yields. Growth-oriented industries such as technology, biotechnology, or emerging markets often prioritize reinvestment over immediate dividend payments. Profitability and cash flow. Industries with higher profit margins and strong cash flows tend to have a higher likelihood of paying dividends and offering higher dividend yields. Companies in sectors such as banking, energy, or manufacturing that generate substantial profits and cash flows may have higher dividend yields compared to industries with lower margins and cash flows. Cyclical versus non-cyclical industries. Industries that are sensitive to economic cycles, such as automotive, construction, or discretionary consumer goods, may have more variable dividend policies. During periods of economic downturn, companies in these industries may reduce or suspend dividend payments to preserve cash. In contrast, companies in non-cyclical industries such as healthcare, utilities, or essential consumer goods may exhibit more stable dividend policies and higher dividend yields. Investor expectations. Investor preferences and expectations also influence dividend policies across industries. Some sectors, such as real estate or dividend-focused funds, attract income-oriented investors who prioritize high dividend yields. Companies in these sectors may strive to maintain attractive dividend yields to attract and retain investors. On the other hand, growth-oriented sectors may have a lower emphasis on dividends, as investors in these industries may prioritize capital appreciation. It's important to note that these factors contribute to the overall variation in dividend policies and yield across industries, but individual companies within the same industry may have different dividend policies based on their specific circumstances and strategies. Investors should consider these industry-specific factors when evaluating dividend-paying stocks and align their investment goals and risk tolerance with the characteristics of the industry and sector they are investing in. Industry trends and market conditions can have a significant impact on dividend yield. Here's an overview of how these factors influence dividend yield. Industry performance. Industry trends play a crucial role in determining dividend yield. Industries that experience strong growth, high profitability, and stable cash flows often provide a favorable environment for companies to pay dividends and potentially offer higher dividend yields. Conversely, industries facing challenges. Economic downturns or disruptive changes may result in lower dividend yields as companies prioritize conserving cash or reinvesting for future growth. Interest rates, market conditions, particularly interest rates, can influence dividend yield. When interest rates are low, income-seeking investors may turn to dividend-paying stocks for yield. This increased demand for dividend stocks can drive up their prices, potentially leading to lower dividend yields. Conversely, higher interest rates may make fixed-income investments more attractive relative to dividend-paying stocks, potentially increasing dividend yields. Investor sentiment, market sentiment and investor preferences can impact dividend yield. During periods of economic uncertainty or market volatility, investors may seek stable income from dividend-paying stocks. This increased demand can drive up stock prices, potentially resulting in lower dividend yields. Conversely, when investor sentiment is positive and risk appetite is high, dividend yields may be lower as investors focus more on capital appreciation, company-specific factors, while industry trends and market conditions provide a broader context. Company-specific factors also influence dividend yield. A company's financial health, profitability, cash flow, dividend policy, and growth prospects all contribute to its dividend yield. Even within the same industry, individual companies may have different dividend yields based on their specific circumstances and strategies. Dividend policy changes in industry trends or market conditions can prompt companies to adjust their dividend policies. During periods of economic uncertainty or financial stress, companies may reduce or suspend dividend payments to preserve cash and maintain financial stability. These changes in dividend policies can impact the dividend yield of individual companies and the industry as a whole. Dividend sustainability, industry trends and market conditions can also influence the sustainability of dividend payments. Companies in industries experiencing prolonged downturns or structural changes may face challenges in maintaining dividend payments. Economic recessions, regulatory changes, technological disruptions, or shifts in consumer behavior can impact the financial health of companies and their ability to sustain dividends, potentially resulting in lower dividend yields. It's important for investors to consider both industry trends and market conditions when assessing dividend yield. Understanding the dynamics of the industry and market environment, as well as analyzing company-specific factors, can provide valuable insights into the sustainability and potential fluctuations in dividend yield. Investors should conduct thorough research, analyze financial statements, and evaluate the overall investment landscape to make informed decisions regarding dividend-paying stocks and their associated yield. 3.3 Dividend history and growth. Evaluating a company's dividend history and track record of dividend growth is an important aspect of assessing its dividend-paying capability. Here are key factors to consider when evaluating a company's dividend history. Consistency of dividend payments. Look at the company's track record of consistent dividend payments over time. A company with a history of regularly paying dividends indicates a commitment to returning capital to shareholders and may be more likely to continue doing so in the future. Dividend growth rate. Analyze the company's historical dividend growth rate. Consistent dividend growth demonstrates the company's ability to generate increasing profits and cash flows. And it is a positive indicator of its financial strength and commitment to rewarding shareholders. Dividend payout ratio. Assess the company's dividend payout ratio, which is the proportion of earnings paid out as dividends. A sustainable dividend policy typically involves a payout ratio that allows the company to retain sufficient earnings for reinvestment and future growth while still providing attractive dividend payments. Dividend yield stability. Examine the stability of the company's dividend yield over time. A consistently high or growing dividend yield may indicate a strong dividend-paying track record and an attractive income opportunity for investors. Dividend policy changes. Consider any significant changes in the company's dividend policy. Assess whether dividend increases, decreases, or suspensions were made in response to specific circumstances, such as economic downturns or strategic decisions. Understanding the reasons behind these changes can provide insights into the company's dividend-paying philosophy and its ability to adapt to market conditions. Industry comparison. Compare the company's dividend history with its peers in the same industry. Look for companies with a superior dividend growth rate, consistent payments, and competitive dividend yield. This comparison provides context and helps determine if the company is performing well relative to its industry peers. Financial stability. Assess the company's overall financial stability, including its profitability, cash flow generation, debt levels, and balance sheet strength. A financially stable company is more likely to maintain and grow its dividend payments over time. It's important to note that past performance is not a guarantee of future results, and evaluating dividend history is just one aspect of assessing an investment opportunity. Consider the company's business model, industry outlook, competitive position, and overall investment thesis alongside its dividend track record. Conducting thorough research and analysis will provide a more comprehensive understanding of the company's dividend-paying capability and its potential to generate sustainable income and dividend yield in the future. Dividend growth and dividend yield are two related but distinct concepts in the context of assessing a company's dividend payments. Here's an exploration of the relationship between dividend growth and dividend yield. Dividend growth. Dividend growth refers to the rate at which a company increases its dividend payments over time. It is an indicator of a company's ability and willingness to share its profits with shareholders. Companies that consistently increase their dividends demonstrate financial strength, profitability, and a commitment to returning capital to shareholders. Dividend growth is often driven by factors such as increasing earnings, strong cash flow generation, and a favorable business environment. Companies with a history of dividend growth are attractive to income-oriented investors seeking a growing income stream over time. Dividend yield. Dividend yield is a financial ratio that represents the annual dividend payment as a percentage of the stock's market price. It provides insight into the income potential of an investment relative to its price. Dividend yield is influenced by both the dividend payment and the stock price. A higher dividend yield indicates a higher income return on investment. However, it's important to note that a high dividend yield does not necessarily imply a strong company or a sustainable dividend. High dividend yields can be the result of a declining stock price or a temporary increase in dividend payments. Relationship between dividend growth and dividend yield. Dividend growth and dividend yield are related but not directly proportional. Here's how they are connected. A. Impact on dividend yield. Dividend growth can potentially impact dividend yield. As a company increases its dividend payments over time, the dividend yield may rise if the stock price remains relatively stable. This is because the higher dividend payment relative to the stock price results in a higher dividend yield. However, it's important to consider the stock price movement alongside dividend growth to understand the true impact on dividend yield. B. Market perception. Dividend growth can influence market perception and investor demand for the stock, which may, in turn, affect the stock price and dividend yield. Companies with a consistent track record of dividend growth often attract income-oriented investors who seek a growing income stream. This increased demand can drive up the stock price, potentially leading to a lower dividend yield. C. Dividend sustainability. Dividend growth is sustainable when supported by a company's financial health, profitability, and cash flow generation. A company with a strong financial position and steady earnings growth is more likely to sustain dividend growth over time. Sustainable dividend growth can contribute to a stable and potentially increasing dividend yield. It's important to consider both dividend growth and dividend yield when evaluating a company's dividend-paying capability. A company with a high dividend yield but stagnant or declining dividends may not be sustainable in the long term. Conversely, a company with a lower dividend yield but consistent dividend growth may provide attractive long-term income potential. Investors should consider their investment goals, risk tolerance, and the overall financial health of the company when assessing the relationship between dividend growth and dividend yield.